Gold hit a record high in January 2026, touching $5,589 per ounce. Today, it sits lower, around $4,300. That means gold has given back a meaningful chunk of its all-time high. And this changes things for anyone thinking about investing. A pullback can mean opportunity, but it can also mean the market is still correcting. In this video, we'll look at 5 ways to get exposure to gold through ETFs. We'll start with the safest options and move step by step toward the more aggressive ones. By the end, you'll have a clear picture of which option fits your own risk profile. Before we get into the options, let's explain why so many investors prefer ETFs over buying physical gold. When you buy physical gold, you have to think about where to store it, how to insure it, and how easy it will be to sell when you need to. With an ETF, all of that disappears. You buy and sell within seconds, right from your brokerage account, just like you would with a stock. And the cost is minimal compared to storing physical gold. The first option is GLDM, full name SPDR Gold MiniShares Trust. It's issued by State Street, one of the largest investment management companies in the world. It trades on the NYSE Arca exchange in the United States. GLDM holds physical gold in vaults, and each share represents a small piece of that gold. Its price tracks the price of gold almost perfectly, with very little deviation. The annual management cost is just 0.10%. It's one of the cheapest gold ETFs available anywhere in the world. Right now, the share price trades around $75. In terms of performance, GLDM had an average annualized return of about 16.7% over the past 5 years. Over the past year, the picture is a bit more mixed, since gold rallied hard through January and then corrected. If you want simple, low-cost exposure to gold without any complications, GLDM is one of the best options out there. The second option is IAU, the iShares Gold Trust. It's issued by BlackRock, the largest asset manager in the world. It also trades on the NYSE Arca exchange. Just like GLDM, IAU holds physical gold in vaults, and its returns track gold's price almost 1-to-1. The annual management cost is 0.25%, a bit higher than GLDM, but still very low compared to other products in the market. Its current price trades around $65 per share. Over a 5-year period, IAU's average annualized return ranges from roughly 10.5% to 16.5%, depending on the measurement period, practically identical to GLDM. The big difference is size. IAU manages tens of billions of dollars, which means massive liquidity and ease of trading. For a beginner investor, GLDM and IAU essentially do the same thing. Choosing between them comes down mostly to cost and personal preference. The third option is especially useful for anyone based in Europe. 4GLD, also known as Xetra-Gold, is a European product issued by Deutsche Börse Commodities, and it trades on the Frankfurt Stock Exchange on the Xetra trading system. The big difference here is that 4GLD trades in euros, not dollars. That means you don't have to worry about currency conversion when buying through a European brokerage account. Another unique feature is that each share of 4GLD represents 1 gram of physical gold, and holders technically have the right to request physical delivery of their gold, something US ETFs don't offer. The management cost is essentially zero, which is rare in the gold ETF space. Its current price trades around €113 per share. In terms of performance, 4GLD delivered roughly a 25% total return over the past year, naturally tracking the euro price of gold. If you're investing from Europe and want to avoid euro to dollar exchange rate swings, 4GLD is a very practical choice. Now we move into a different category. GDX, the VanEck Gold Miners ETF, doesn't hold physical gold. It holds shares of companies that mine gold and silver. It's issued by VanEck and trades on the NYSE Arca exchange. Its largest holdings include well-known mining companies like Newmont, Barrick, and Agnico Eagle Mines. This means that when you buy GDX, you're not investing directly in gold, you're investing in the profitability of these companies. Why does this change the risk? Because these stock prices are affected both by the price of gold and by mining costs, company management, and the broader stock market. This creates a leverage effect. When gold goes up, GDX tends to go up by much more. But when gold drops, GDX can fall even harder. The management cost is 0.51%, significantly higher than the physical gold ETFs. The current share price trades around $77. In terms of performance, GDX had an incredible run over the past year, with a total return above 100%. Over 5 years, the total return exceeds 160%. These numbers sound amazing, but you have to remember that GDX can have equally sharp drops during tough periods for the mining sector. GDX fits investors who want greater upside potential and are willing to accept the bigger swings that come with it. The final option is the most aggressive one. GDXJ, the VanEck Junior Gold Miners ETF, invests in smaller, growth-stage gold and silver mining companies known as junior miners. It's also issued by VanEck and trades on the NYSE Arca exchange. These smaller companies have much greater upside potential compared to the large, established companies in GDX. But that also means much greater risk. Smaller companies mean less capital, greater sensitivity to operational problems, and much higher volatility in share price. The management cost is 0.52%, similar to GDX. The current share price trades around $101. In terms of performance, GDXJ rose roughly 56% over the past year. In previous periods of strong gold rallies, it has posted returns above 170% within a single year. But the same logic works in reverse. During tough periods, GDXJ has historically lost more than 80% of its value from its peak. This ETF is not for beginner investors. It's for those who fully understand the risk and are psychologically prepared to see large swings in their portfolio. Let's recap the 5 options we covered today. If you want simple, low-cost exposure to physical gold from the United States, GLDM and IAU are your top choices. If you're investing from Europe and want to avoid currency exchange exposure, 4GLD is an excellent alternative. If you want greater upside potential through large mining companies, and you're willing to accept more volatility, GDX is your option. And if you want the highest upside potential, paired with the highest risk, GDXJ is there for the most experienced and bold investors. Gold has pulled back significantly from its all-time highs in January. If you believe that uncertainty in the global economy will continue to support the price of gold, these 5 options give you different ways to position yourself, depending on the risk profile that fits you. Always remember the basic rule. The greater the upside potential, the greater the risk. Never invest money you can't afford to lose. And if you're a beginner, always start with the lowest risk tier. If this video was helpful, hit like, subscribe, and let me know in the comments which of these ETFs interests you the most. See you in the next video.